Let's get some analysis now on what moved the markets, or what's moving the markets recently, with Roger Montgomery from the Montgomery Fund. Roger, great to have you in the studio today.
Great. I was just listening to that, and I think if the government wants to help small business, they should allow startups to have a tax holiday.
Oh, really?
3 years, no tax for the first $300,000 profit.
We're actually talking about small business quite a bit later in the show.
I'm glad to hear it.
I'll be sure to bring that up. Let's talk about markets, because they have been at record highs globally. What's driving this?
Well, it's not happening in Australia, and that's the important thing. And what's driving it is the same thing that's driving it in Australia, and that is yield compression. So what that means basically is interest rates are very low everywhere else, so people are looking for higher yields. But that in itself is a problem, because what it does is it gets people starting to treat the stock market like an ATM machine, where they think it's going to be stable and they're going to pull their money out. The difference with Australia, of course, is that we have much higher labour rates and much more expensive rental costs, and so American companies in particular are able to actually generate increased profits through efficiencies and low labour costs. We don't have that here. The problem for the Australian market is that if you look back to 2006 or 2007, the stock market, the ASX 200, is actually no higher than it was back then. And the reason that's the case is most of the constituents of the index haven't added economic value. Now, on top of that, the market's now expensive. And if we look at this particular chart, which I've put together, and hopefully we'll see that come up on the screen, what we're going to find is that the stock market, compared to its intrinsic value, is actually significantly higher than our estimate of its value. So what we did is we took the top 200 companies, we aggregated their intrinsic values, and then when we added them together, we came up with an intrinsic value for the whole market, weighted for the market. Is that it there? Okay, terrific. So you can see that dashed horizontal line, that represents an intrinsic value estimate for the ASX 200, and it's plotted against the ASX 200. And you can see that over on the far right-hand side, where it is now, it's expensive. So the stock market looks expensive at the moment. In fact, you've got Simon Bond coming up after the break. He and I were in the green room prior to the commencement of the show. It's not that green, really, is it?
It's not.
It's sort of a browny mottled colour. But we were chatting, and he and I were both saying we can't find any value. And in fact, that's one of the reasons why I think some of the floats are really popular at the moment, because the market's expensive. There isn't much value in established companies that have been listed already. And so we're looking to these floats for value, and some of them are being brought on the market at cheap prices because they've got private equity vendors who need to, if you like, strengthen their reputation because previous floats didn't go so well, so they want this next float to go really well because they've got a banked pipeline of new floats. So this next one that goes needs to be a good one, and so we're taking advantage of some of those.
And the floats have been doing pretty well. They've been rallying pretty much straight off the bat.
Well, they've been priced attractively to get them away, because in some instances the private equity owners haven't had such a good run before, or they've put something out to the market that didn't go so well, so they need to appease the market and reinvigorate interest in their forthcoming float, so they've made the first couple attractive.
Now, Roger, from the chart we saw before, you found 4 companies from the top 100 that are a discount to intrinsic value.
This is a massive problem at the moment. Out of the top 100 companies by market capitalisation, we can find 4, using Scaffold, which is our online investing tool, we can find 4 top 100 companies that are currently at a discount to intrinsic value.
Right, and that's not even taking into account anything else, it's just at a discount.
Just at a discount. So we haven't even looked at yield or quality or any of those other things, just the top 100, all of them, 4 of them. That means, now, before you go rush out and buy them, and I can tell you what they are, one is Leighton's, one is Fortescue, one is Orica, and the other is JB Hi-Fi.
Okay.
Right, so they're the 4 that seem to be, and for those who missed it, it was JB Hi-Fi, Orica. I'm sure people are saying, what were they again? JB Hi-Fi, Orica, Leighton's and Fortescue. But I wouldn't be going out to rush and buy them, because if there's only 4, that means there's 96 that are expensive.
Right.
96 of them are expensive. So that tells me, rather than go and rush out and buy the 4, think, hey, there's 96 hanging over the market like a rain cloud, ready to dump. But I don't know, let me say this, I do not know And unlike some of your other guests, I don't know whether the market's going up or down.
Right.
I just don't know.
But
that's not our job.
In that sense, would you still want to sell maybe some of these if they're looking expensive?
The most expensive ones we do, but that's part of our approach.
Right.
When we see that the market in aggregate is expensive, then what we tend to do is we start to shift to more cash. So we have a little model that tells us our portfolio is net expensive or cheap, and as it gets more expensive, we start selling our most expensive holdings, and that raises cash.
Now, with something like a Leighton's, does that take into account, obviously, the cheapness recently?
Takes into account everything.
Right,
yeah.
so that would be a tough one to buy as well, because then you've got the overhang of some of the corruption scandals.
Now, you're raising a different issue, right? So you have to, when you're investing in individual businesses, often the opportunity to buy something cheap is because something negative has befallen the company.
Right.
What you have to do as an investor is ask yourself, is this a problem of a permanent nature or of a temporary nature? And if it's temporary, well, it's a diamond in the rough,
yes,
right? And you want to buy a lot of it. And it requires you to be patient because they don't happen very often. Before, Leighton's isn't one that we're buying, but one that happened recently that we did buy was Macmillan Shakespeare. And we were the largest buyer of Macmillan Shakespeare shares when it relisted after Kevin Rudd had said, remember Kevin Rudd came out and said, we're changing FBT, you're going to have to keep a logbook and all this kind of stuff. Dropped from 18 to 15 or 14 and then was suspended. Then it came on again at 7. Our average purchase price was $7.25, and we were the largest buyer in the market in the early part of the day, and now they've been $13. So diamond in the rough. You have to ask yourself, is it a permanent problem or a temporary problem?
Now, a lot of people are saying, because valuations are stretched, yield can make up for that, and perhaps, for the banks and things, that is a huge mistake?
Massive mistake. And people will lose money if they chase yield. Very quickly, I'll give you an example. In 2005, you could have put $100 into Telstra, and you could have put $100 into M2 Telecommunications. Telstra had a 7.4% dividend yield. M2 Telecommunications had I think it was a 4.2% dividend yield. So the dividend yield for Telstra in 2005, much more attractive than M2. Okay, fast forward to now, your $100 in Telstra is worth about $98. So it's gone down, only slightly, but it has gone down. And your yield, your income, which was $7.40 back in 2005, is now about $5.80. So your yield has gone down just as your capital has gone down. Contrast that with M2 very quickly. M2's gone from $100. That $100 is now worth about $1,500. So you've made 15 times your money, and the income of $4.20 is worth about $58 of income. So you're better off to go for good businesses that are cheap rather than businesses that have got a high dividend yield.
Speaking of good businesses that are cheap, you said one out of the whole 100 is one of your highest quality businesses that's come on cheap.
So out of the 100 companies, we rank companies from A1 down to C5. C5 has the highest risk of catastrophe, and an A1 has the lowest risk of catastrophe. There's 18 A1 to A3 companies, and of those, one is currently cheap, and that's JB Hi-Fi. We own JB Hi-Fi, but we bought it a lot lower than where it is now. So the margin of safety is much smaller, but it's still at a slight discount to intrinsic value. That's the only one out of the top 100 companies that's good quality and cheap at the moment.
What about the micro end of the market? Is there anything you're seeing there?
Oh boy, yeah, we're seeing something, but we don't like what we're seeing.
Okay. Let
me give you an example. There's 3 sort of nano cap internet businesses, Mint Wireless, the other one, I'll have to think of it in just a second, Embrace Mobile is another one, and I can't think of the third one. I'll come back to you on that. But those 3 businesses have a combined market capitalisation, brace yourself, of roughly $300 million. And out of that $300 million, their total revenue, 16 million. And in the last financial period, they lost Smart Trans, it's called.
Okay.
That's the third one, Smart Trans. And in the last period, they lost $4 million. So the combined revenue, 16 million, they lost 4 million, and their market capitalisation about $300 million. That's a mini bubble. Now, it doesn't mean that it's not going to bring the whole market down unless people are massively debt funding their purchases of these companies. But the definition of a bubble that pops, that damages the economy in general, is dependent on how much debt is used to buy those assets that turn toxic. But so there's not a lot of debt at the moment in the market, but nevertheless, there are mini bubbles going on everywhere, and more importantly, the big market, the big 100, has been chased up for its yield, but the valuations now don't justify the prices.
With all this in mind, Roger, what should investors be doing? Just looking
Be
for quality?
very, very cautious. If they've got an account with Citibank or UBS or some of the other brokers, Bell Potter, for example, that are floating some of these companies, do your darndest to try and get an allocation to these floats, because some of them are actually pretty good and they're being brought on cheap. There's not a lot of value anywhere else.
All right. Roger, there you have it. Roger Montgomery there from Montgomery Investment. Thanks so much for your time.
It's a pleasure.